Okay, great. I think I already see people in the room, so I think we're ready to rock and roll, Emily, once again.
Okay, great.
So, welcome back to our annual tax and financial planning update. And this is really geared towards US citizens who are living or moving to Germany. And we're so excited to partner again with the American Women's Club to just offer this as an education opportunity. If you can't stay the whole time or you're watching this as a recording, we are going to record it. If you've registered, we will send the recording. We're going to keep the recording private for the next 30 days. So it's just accessible only to American Women's Club of Berlin members. So you have that access. So, Emily, this is what, webinar like 3 that we've done this month or in the last month. So, we're really excited to do I don't know, we love these even though it's Thursday right before we all go on Easter break. So, if you are attending live, thank you so much for being here. Again, this is recorded, but you are welcome to put your questions in the chat. We have an hour scheduled today, and usually our presentation takes around 45 to 50 minutes. And so we are going to do our best to get through all of the questions that you put in the chat. Just be mindful that, again, this is going to be available publicly. So if you have really personal information that you don't want shared publicly, please do not put that information in the chat. A reminder, Emily and I are not your advisors unless we have an agreement in place. This is general advice that may or may not be applicable to your unique situation. So be sure to speak with your financial advisor, your accountant, or lawyer for advice that is directly related to your situation. And then very quickly, our introductions. So my name is Arielle Tucker. I'm the founder of Connected Financial Planning. I'm a US expat as well. I've been personally and professionally exploring cross-border tax and financial planning issues for the last 15 years. I used to live in Berlin, which is what my connection is to the club. I currently live in Switzerland. I own and operate Connected Financial Planning, which is a fee-only financial planning firm. We say fee-only because we are only compensated directly by our clients and we do not sell products. I've written for Bloomberg and been featured in a number of media outlets, including Forbes, CNN, Yahoo Finance, etc. I also host a weekly podcast for current and aspiring US expats where we cover lifestyle, tax, and financial planning topics. So be sure to listen in to Passport to Wealth on your favorite and then feel free to connect with me or Connected Financial Planning on LinkedIn and Facebook, where I engage all the time on tax and financial planning topics. There's so many topics that are really impacting us. I think we had hearing yesterday for birthright citizenship. All these topics really impact expats. So I love talking about those all the time. And Emily, I'll let you introduce yourself.
Yeah, hi, I'm Emily Haynes. I'm the owner, founder of Expat Tax Solutions. So we specialize in U.S. taxes for Americans living in Germany. I started that in 2017 when I was living in Berlin. Right now I'm in Seattle, but we'll be back in Berlin in a few weeks. Hopefully I can see some of you in person when I'm there for the whole summer. And yeah, the firm's been growing pretty fast ever since. And we've really developed a deep expertise on US tax situations for Americans in Germany. So I'm excited to be here to give a little update for the 2026.
Okay, great. So let's kick things off with our presentation. So we'll get right into our US tax updates. And again, submit your questions and we will look at those. If you see something that's applicable in the chat, Emily, feel free to stop us. Otherwise, we'll just kind of keep going and plan to look at all of those questions towards the end. And we may get to your immediate question during the presentation. So starting off with the basics, the US still has citizenship-based taxation, which is not residence-based taxation, meaning if you are a US citizen, a US green card holder, or otherwise considered a US tax resident, you likely still need to file a US tax return. The actual thresholds for filing a tax return vary. We'll look at those on the next slide. But the income thresholds vary, and they're as low as $5, which is for married filing separately, which includes anything from investment income or earned income. If you are a US visa holder and you've left the US, you still need to file a final tax return to show that you've correctly left the US tax system. And a good point, Emily, that we were discussing before was having to file a tax return doesn't automatically mean you're going to owe any US tax. And I think that always trips up people, the fact that we have to file and we may just end up with no refund and no tax due, but we still have this massive accounting exercise that we have to go through every year, which is a little bit painful. And then we get, oh, I'll let you
Oh,
run through I'll let you there.
yeah. So the thresholds have been increased. They're inflation adjusted every year. So for people under 65, thresholds are ranging from 15,750 to, if you're single, to the 31,500 for the married filing jointly. What's really notable is that the married filing separately, which is the majority of people who are U.S. citizens living outside of the country who are married to a non-U.S. person, is generally going to use a married filing separately status. So that threshold is $5, and that's pretty easy to achieve, even if you don't think you have any income. Just through some interest income could easily get you to $5. Sometimes, if you have a U.S. citizen child who can be claimed as a dependent, you might be able to use that head of household status and then have that 23,000 threshold. And then the other notable one is if you have any self-employment income, that threshold is $400, which is also quite low.
Yeah, and I know we bring this up every year just about if you do have those dependent children, you can consider filing head of household even if you're married to a non-US person. And that's a really important planning opportunity and, tax consideration for US citizens who have those dependent children. Also, another thing that I want to point out is on this slide, it says 2025 minimum income filing thresholds. That is not a mistake. We do that on purpose because we are currently in tax season. And so we're still thinking about the tax return that you're going to be filing for 2025, even though we're in 2026. Okay, and then let's run through some important dates. We have one of those dates coming up around the corner, Emily. Why don't you run us through what we should know about the dates this year?
Okay, there was a question I want to go back to because it's really relevant. This is your
Yep.
worldwide income. So as a US citizen, you're taxable on your entire worldwide income, not just the US based income. So even if you're making a salary in Germany, if you have bank interest from whatever country, Ireland, those are all reportable as income in the US. If you have a rental in Germany, that would all go on your US tax return.
Yeah, and that goes both ways. I mean, I get this question also on the other side of things. Well, if I have a US LLC or I have a US employer and I'm living in Germany, I don't have to report that income, or I only have my brokerage account in the US. But it's both countries kind of operate in that same vein. If you are a German tax resident, it's worldwide reporting. Maybe not all the income is taxable, right? We have certain types of income that might not be taxable in Germany, but you still oftentimes need to report it. And in the same way, the US is the same thing, right? We have that worldwide filing requirement.
Yeah, so deadline. So April 15th is the one everyone knows about. So that's the filing deadline if you're living in the US. And that's also the payment due deadline if you owe anything in the US. Then if you live outside of the US, you get this automatic extension to June 15th. This year it's the 16th because of weekends. So you don't have to do anything at all for that extension. It's just automatic by living outside of the US. And if you owe anything and you live outside of the US, if you don't make that payment on April 15th, it only accrues interest up until June 15th. So there aren't payment penalties until that June 15th date. So right now that interest rate is, I think we could go into this later, 7%. It's about to drop down to 6, but that it can be
Did you
like
just
quite high.
say 6, 7?
I did. So if you are not going to have your documents together or get your filing done by June 16th, then you can request an extension, you can file the 4868 and get an extension to October 15th. That's also when the FBAR is due. And then for a lot of people in Germany, especially if you have a rental property, those documents generally aren't available, or maybe you're fighting with your German tax preparer about getting your US return done early enough to file. There's an additional extension available to December 15th for anyone who lives outside of the US. There's no form to request that. You have to send a letter to the IRS just saying that you live outside of the US and that you're not going to have your documents in time and you would like an extension until December 15th. And they have to receive that before your previous extensions expire. So if you filed the 4868, you get the extension to October, and then you need to send them a letter so that they receive it before October 15th to request the December 15th extension.
And I think the really important point there is it's not automatic. They can decide, no, we're not going to grant this extension for whatever reason. So it is something to make sure you're planning ahead and aiming to try to do October 15th. I always tell individuals, especially in Germany, because in Germany, if you're working with a professional preparer, you get like even more time to file your tax return. But let them know you are a US person, you still need to file a US tax return, and make sure you're getting your documents ahead and communicating that you really expect to get your tax return done ahead of schedule. I think that's very important. The other thing I wanted to say for the upcoming April 15th deadline, we still have time to make traditional IRA contributions. So if that's part of your financial plan and it makes sense to you to do from a US tax perspective and a German perspective, you could still do 2025 IRA contributions through April 15th, 2026. That is one thing that you can do for 2025. Okay, let's talk through some of the changes. So like Emily was saying before, we have some changes every single year. So the big one, a lot of people will take the foreign earned income exclusion, and that does increase for a little bit for inflation from 130,000 to a little over 132,000 this year. Though, Emily, you made an excellent point in our last conversation that we had around this. That increase is not going to cover for the exchange rate difference. So the big thing to consider for 2025 filing is on paper, because the dollar weakened against the euro, it looks like you made roughly 10% more in dollars, even if you have the same job and the same income in euros, right? So on paper, it's just something to be aware of. The foreign housing exclusion, that increases as well every year. This is what you were talking about before, the interest rates. So in Q1, they were 7%. They're now down. They've dropped down to 6%. So we are seeing the interest rates come down. We already looked at the different income tax brackets. Those are adjusted every year. And then a very important point for anyone with children is considering those refundable tax credits, which are currently $1,700. That's $1,700 per child that you can get back from the IRS, even if you don't owe anything. And that's very powerful. But you need to understand you only get that if you don't claim the foreign earned income exclusion. You have to file a return and claim the foreign tax credit, which generally you still won't owe any additional tax because German tax rates are generally higher than US taxes. But it is something that you need to understand. If you want to have a refundable credit, you do need to file with the foreign tax credit and not with the foreign earned income exclusion. Do you have anything to expand there?
Yeah, so in order to claim your child on a tax return, they have to be a U.S. citizen with a social security number. And I think it can be bureaucratically challenging to take the extra step to file for the social security number for the child if they're not born in the U.S. And so in the sort of having a new child busyness, we see that often sort of gets pushed down the road. But $1,700 per child is not a small amount, and they're eligible for that from the time that they receive their social security number up until when they turn 17. And especially if you have multiple children, that will stack up quite a bit. And so I do think it's worth it to really prioritize getting that social security number. You have to receive it by the due date of the extended due date of the filing. So you could file now and get that by, and then do the extensions to December 15th, as long as you have it by, early enough in December that you can file your tax return, then you can qualify for it. So sometimes we'll just hold it.
Have you ever seen anyone do an amended tax return? So they had to
They don't allow
file,
it.
they won't allow it. Okay.
So if you don't have the social security number, we file amended returns to claim child tax credits that were eligible if there was already a social security number. Yeah, we'll claim that. We've had good luck. I think last year we got some funny responses that we're trying to push through. So I don't know if they're kind of cracking down on not an amended return, but we have claimed a lot of refundable child tax credits. We find it often when we get returns from another preparer that they didn't claim it.
Yeah, and I will just
those
say,
are my favorites.
in my own situation, we were in Germany on an official assignment, and so we had corporate tax support, and they were doing this really crazy, TEQ calculations. We work with clients who have these TEQ calculations, and they decided they were going to take the foreign earned income exclusion for us. And I was like, this doesn't make any sense because we're in Germany. Whatever. They did the TEQs, made everything fine. But then we went back and amended those returns to the foreign tax credit so we could get all the refundable child tax credits. So
yeah, we've definitely done those for same situation with the big four firms, which also I used to work in big four firms. So
me too.
I'm delighted anytime I can correct the filings of anyone from those firms I used to work for.
Yeah, yeah. And it has changed a lot, at this point, a lot of that is all shipped out now. So it's definitely different than it was when I was working there. And I think probably for you as well. The other thing, there is a note here that the gift tax limits, just kind of some considerations here, but we always have to align these with German inheritance and gift tax thresholds. So these exist on the US side, but they also exist on the German side. So it's just something to be aware that when you're receiving or looking to gift gifts, you kind of have to look at it on the lens of both sides. Then some other changes we had here. So we do have a significant increase this year for retirement contributions. So now for 2026, that goes up to $7,500 or $8,600 if you're over 50 this year. And again, if you haven't done 2025, you can knock out 2025 and you can already do 2026 as well. Other provisions, you made this slide, so I'll let you talk through it.
These are some changes from the new tax legislation. They're not super relevant for people living abroad. I think what we find a lot of times is there's new deductions available in the US because, especially when you're living in Germany, there's multiple ways to zero out your income. And so we want to take the easiest path. So once you've taken the foreign earned income exclusion or applied foreign tax credit to zero tax, then, maybe there's no tips, no tax on your tips. But if you're already at zero, then, and you already paid tax on it in Germany, that's not the greatest benefit for you personally.
Okay, and then we've talked about this the last couple of years. I'd like to say that it's getting better. I'd say it's gotten worse.
Yeah.
We got just really low levels of support. If you do need the IRS right now, I would say call in the morning. I like to call, first thing in the morning when they open, which I think is about 7 a.m. right now, which is about 1 o'clock here. Call first thing in the morning. And I like to call Tuesday through Friday. I don't call on Monday because that's always the busiest day. But you can still get through. You can still get support. But just be aware that levels were cut, I think, by about 25% last year.
Yeah, I like to call not around tax deadline. So I would not call them now, I would file an extension and call them on April 16th, 17th, when like not the entire world is trying to call them. Filing, they used to process e-filing returns if you're waiting for a refund within it seemed like a few days. I never paid attention because it was very fast. And it's definitely slower this year. They're sending notices that if you filed an amended return, they haven't processed it yet. We're looking at least a year, I think, to process an amended international return. And they may send notices. So, like, if you're getting a notice, your response is to file an amended return, and then they're taking forever to process that. Those notices are going out on like an automated schedule, so you might still get them until they get processed. So it's important to be patient.
We were seeing some incorrect notices also going out with clients. So if you do receive a notice, don't panic. Take it to your tax preparer and make sure you understand it, because sometimes they accidentally send out notices to people who shouldn't be receiving them, and then you just need to make sure that you can navigate that. The other thing we talk about a lot is making sure that you e-file. There are some types of preparers that are not authorized to e-file. So if that is you, my recommendation, transparently, would be to switch preparers, because at this point, with all of the backlog that the IRS has, you do not want your paper return going and sitting in a pile for the next 6 months to a year. It's much easier to e-file. You get the transcript. Everything is just, your life will be easier to e-file in our current state of the IRS.
Yeah, there's situations where you may have to paper file. In that case, it's important to keep good records of your tracking numbers to make sure that
taking pictures of the tracking number, paying for the tracking. Really, really good documentation. Don't just stick it in the mail. I've even done that a couple of years ago. I just stuck, like, we had to paper file and I stuck it in the mail, and then I had to resend it 6 months later because I hadn't received it. So learn, like, even I make mistakes sometimes with the IRS. So make sure you take a picture of that tracking number. And they still took so long to process it that I had to like pull up the tracking number and say, look, I see that you've received it. Like, where in the world is this tax return? So very, very important.
There's also a question about refunds. Those can only go to U.S. banks. Yeah.
You know what? I have a question. I don't know if you've had this, but one of the things I would think for people who don't have US banks anymore, one, the State Department Federal Credit Union is probably like, you can still get an address, you can still get a bank account even with a foreign address if you really want kind of an easy bank. The other thing I would think would be like a Wise account, because Wise accounts, if you have
Wise won't do it because I don't think they have US. Do they have US accounts? It has to be a bank account that the bank account is physically in the US, so not.
They have US bank partners, and I'm just going to I'll research that and I'll make a LinkedIn post next week about my findings, because I'm curious, because I know a lot of our clients now have all these multi-currency accounts. They may actually be able to receive
a
deposit that way.
Sure about Wise. There is another similar company called Currencies Direct, and they are definitely able to receive. They set up kind of like they hold the account even if you're not able to get a US account. It's like a custodial something that they can.
That's kind of, it sounds like what Wise is doing as well. So check if you don't have that and you don't want to have the hassle of going and getting a US bank account, check your provider. There's a bunch of Currency Direct, Wise. You can look into whatever and see if you get it. What you don't want to do is get a paper check. And I know they've stopped issuing paper checks, but I actually just got a paper check, even though I'd listed a bank account for a refund. So something also to consider.
Great. And then someone added in the chat that AWC members can get a State Department Federal Credit Union account even with a German address.
Yes. I think I just said that. Yes.
Yeah.
Okay. Oh, wait, we didn't even get to the slide. Sorry. So building wealth, I mean, this is a lot of our practice focus. I think where it's really hard is you always have to go through planning from a lens of both the German side and on the US side. And oftentimes the tax incentives don't line up here. And that's like the really difficult thing, right? If you open up a private pension in Germany, there's some tax incentives around that. Unfortunately, on the US side, that's going to make your tax situation a little bit more complex. So you really have to weigh both sides of things. German real estate, right? We have a lot of tax incentives around German real estate. It could potentially be tax free, but on the US, we have thresholds that you have to consider. So there's some additional currency considerations and just tax considerations if you're a US person. German life insurance products, especially those with investment elements to them, can again be really complex from a tax preparation perspective. So anything that you're looking at doing, I would say make sure you run it through your financial advisor or your tax accountant to make sure you understand how is that actually going to impact your overall financial plan. And then Social Security. Do you want to run through this one as well?
Sure. So when you make Social Security contributions in Germany, so the German written Versicherung, you don't have to report those contributions to the US. There's a treaty, there's a really nice treaty for Social Security between Germany and the US. And that means that kind of on the back end, they're seen as equivalent. So you can make all of your Social Security contributions in the US, and then you can get them transferred to the German written Versicherung system if you're retiring in Germany, and you can pull them out through the German written Versicherung system. You can move them from written Versicherung back to Social Security system and pull them out through the Social Security system. And once you start receiving that income, it's reportable on your US tax return, but it's only going to be taxed in the country of residence. So this is like the nicest provision and the like best provision of the German tax treaty, where they say actually for Social Security specifically, you're only taxed in the country of residence. Not this thing where like it gets taxed first and then you take foreign tax credits. It does not go into the tax calculation, but it does need to be reported, especially if you're getting it on a 1099 form, so that the IRS knows that you didn't just not report it, and you have to claim the treaty position to do that.
And I think this is also interesting, not just for Social Security, but also for like pensions. We've had a number of clients who've worked in Germany, and then, right, you kind of get some, again, there's some tax incentives around saving for retirement through your employer provided pension, and then maybe you go and you retire in the US. It's always interesting to me that those pension distributions are now only taxable in the US, right? So
Mm-hmm.
you get the tax savings on the German side, and then you're paying the lower tax rate on the US side. So also really interesting. To me, that was really great for the employer provided pensions, but you and I both know we've talked a lot about those private pensions, and those private pensions, you have to look at them on a case by case basis. They're like snowflakes in Germany. There are so many different flavors of these private pensions that I always, even when clients bring them to me, I say, let's take this to your tax accountant and have them confirm, because ultimately they're the ones who are going to be filing the tax return and are going to take the position, is this a passive foreign investment company investment or not? And I'm more comfortable with that because I've looked at some and said, you know what, if I was filing this tax return, I wouldn't consider this a PFIC. And then I've had tax preparers say, no, we always assume that they're PFICs. And that's our firm position. So just something to be aware of.
Yeah, and I think so. The treaty is saying that pensions are only taxable in the country of residence, but then we get into like a linguistic thing of like what is a pension. And German tax, this happens also on the German side, where German tax advisors may take different positions on like, is a Roth a pension? You know, is this specific thing, does it count as a pension? Does it count under this treaty provision? And then on the US side, we're also looking at like, okay, this is called Rentenversicherung, but is it structured like a pension, or is it structured like an investment account?
Yeah, really good point. And just to give you an example, I have two clients navigating inherited IRAs at this current moment in different parts of Germany. And their tax accountants are getting different rulings. And what's always interesting to me, like in Germany, we have a federal system, right? It's not like the US where we have, 50 different states, but still regionally, how they interpret and how they understand things can be very different. So again, when we're talking about large amounts of money, I am really in the vein of being proactive, going to them ahead of time and saying, this is a potential situation that I might be dealing with. How would you treat this decision? And even amongst advisors, right? You might find if you don't like the answer, talk to someone else because it's really, really varied.
Yeah. So the streamlined foreign offshore filing is if for anyone who's maybe many years out of compliance with their U.S. taxes, this is a really generous program that the IRS offers to come back into the system. We do a ton of these. So in order to qualify for this, you have to have been outside of the U.S. for 330 days in one of the tax years that you're filing. So this is a really weird, it's a really weird requirement because you could live outside of the U.S. for your entire life, but maybe you just have spent 4 weeks in the U.S. every year. And then you wouldn't qualify for it. But if you've been outside of the US, what's really nice about it is you only have to do the last 3 years of tax filings and 6 years of the reporting your bank accounts. And then the IRS kind of accepts that they won't bother with anything before. So if you haven't filed your US taxes for 20, 30 years, then this is really nice to get back into the system and just do 3 years instead of going back to all time.
And I'm so surprised still. I mean, I started working in tax back in 2012 abroad, and I'm surprised that we're still seeing these streamlined program, these filings from people who are still kind of coming out of the woodwork of, I didn't realize I was a U.S. person, mom's a U.S. person, I realized I wanted to study abroad or I wanted to work abroad, and I'm a U.S. person, I had the right, and oh my gosh, I didn't realize I have to file tax returns. So it's always interesting, and I'm glad that this program is still alive, and it is a good opportunity to kind of come into compliance. Okay, and then we talked a little bit about this citizenship-based taxation in the beginning of the presentation, right? What is that? And this is one of the promises that at the time it was candidate, now President Donald Trump discussed, was ending residence-based taxation. He's looking to end the birthright citizenship. I mean, there's a lot of things going on. I think in my career, I never thought I would see this, but there has been active movement. A lot of that, I would say, I can give credit to there's an organization, and now I'm blanking on their name.
It's I think it's called Accidental Americans, Association of Accidental Americans. It's a French-based organization.
Yes. They're doing a great job. They've hired like a actual firm to go in and try to make some movement on it, and we are seeing movement. So currently we do have a bill that's introduced, which is honestly already like such a high threshold. I don't think there's been any major updates since it was introduced. I don't know if you have any updates, Emily.
Yeah, so it's just been sitting in committee since December of 24. So who knows what will come of it. I feel like in the tax world, the conversation, I mean, when it was introduced, people were like, whatever, that's no chance of anything happening. Yes. But I think at this point, the conversation is like, well, there's a lot of crazy things happening. So maybe this is also a crazy thing that could happen. It's a really interesting proposal because it is for long-term people who live outside of the US, and it would create a way to, if you comply, so you have to be compliant with 5 years of tax. It's similar to the rules for expatriation. Then you can get a certificate which would allow you to be treated as a non-resident until you move back to the US. And you have to be intending to be outside of the US for 5 years or have already been outside of the US for 5 years. There's some fuzziness around it. But this would be really interesting for, people who are really committed to being outside of the US, where once you got that certificate, you would be able to do all of the financial things that you're blocked from doing as a US person outside of the US now.
It will be really interesting. Like obviously we're watching this very closely, but like thinking about FATCA and how that can kind of create some institutional access issues, like how this would actually change potentially institutional access or what we could do as Americans abroad. Like it's very fun to dream about it and think about it, especially like I'm a long-term, expat. You've been abroad for different chunks long term. It would have a huge impact. And I think there's an estimated over 9 million Americans abroad right now, and there's only a couple 100,000 of us who are actually filing tax returns abroad. So it would be really interesting to see like what this would mean. Okay, we have talked a little bit about this, but there are a lot of issues for US expats abroad. As you know, as I know, we're living it. We just talked about some, limited institutional access, right? You can't do what your neighbors and colleagues and maybe friends and family are doing because you are walking this tightrope of being a US expat. And, it's like walking a tightrope and wearing handcuffs. So you do have a lot of limitations about what you can do. Being able to access US ETFs when you're in Europe can be really difficult, right? Because of regulation that's on the European side. And then on the US side, not all custodians want to work with Americans abroad, right? So you're kind of left with two main options, IBKR or Charles Schwab. But if you are not considered an accredited investor, you may not be able to access actually purchasing US ETFs without going through a financial advisor. Obviously, there's additional FATCA compliance considerations. We've talked a little bit about the FBAR. The FBAR is a completely separate filing from your tax return. And we also talked a bit about PFICs, right? And so oftentimes we're seeing people kind of accidentally buy those. Maybe they're a dual US German citizen. They present really as a German citizen. They go to their bank. They go and say, oh, yeah, I'm a German citizen. I want to buy some investments. And then all of a sudden we end up with foreign. And when I say foreign, we're talking non-US investments that are treated tax punitively. Or we're talking with a colleague who recommends an advisor to sell you a pension product, which is not recognized on the U.S. side. And again, now all of a sudden we end up with foreign investments. So you really have to kind of consider again both the German and the U.S. considerations when navigating any financial decisions.
And there's a question that fits perfectly in here. So what if a couple files jointly and there's a non-U.S. citizen who holds all of the funds? Does this cause issues as well? So I think there's two things. You can file jointly in Germany and separately in the US. So as long as that's the case, so the non-US person is not on the US tax return, then there's not a PFIC issue. They can hold, the non-US person is outside of the US tax system. And that's a great
planning opportunity. We call those mixed couples. And I'm like, yes, because that non-US person can do things and simplify things. And it's like we kind of have a couple of considerations. Like you said, you have the German tax return, which you could file jointly. If that makes sense for you, you could still file that return jointly. But it doesn't mean that on the US tax return, you have to file jointly. And in fact, I would do everything, unless there was really a very specific planning opportunity, to keep that non-US person off of the US tax return. Because once they're on there, it's, if you take them off, that's it. It's not like an annual election. Okay, well, this year I want them on, and next year I don't want them, on here. So you do that, like that is a planning opportunity. If you're globally mobile and you're moving in between high tax countries like Germany and low or no tax countries, it's a consideration. And you need to kind of be planning out not just the one tax year, but multiple tax years. The other thing, we have marital assets, right? So you also have to think about, do we have a prenup? Do we have a postnup? How are we titling marital assets? That's another consideration, because I've also run into situations where the non-US spouse is so scared of the US government or the IRS that they decide that there's no assets in the spouse's name. And technically, marital law in Germany, there would still be unless there's a very clear pre or post nup, those would still be marital assets. But if the marriage goes south quickly and things fall apart, it may be a struggle for the person, the US person who has no access to any of those assets, right? You may legally have a right to them, but you might have to go through a court process to get it. So it's just something to be aware of as you're having those conversations with your partner. Okay, we talked a little bit about this already. The German tax system is a progressive system. So we'll kind of keep breezing through so we can get through the questions. Yeah. Keep going. I always think it's interesting. We talked a little bit about this last time. We have these kind of additional taxes in some cases, the solidarity surcharge, as well as the church tax to consider. And just like for kind of a point on the church tax, I always find this like so interesting. It's something that you declare when you're like entering Germany. They'll ask you like, what is your religion? And if there's an applicable church tax, they'll apply it to you. If you end up going to an international church, they may not receive any church tax because they're not part of that system. So just something to be aware of as you're declaring your religion for any reason. Then we've got a German inheritance tax versus US estate tax. It's very different, right? On the US side, this is the old number, but the current threshold is about $14 million, and that's per person if you're married. So on the federal level, less than 1% of US citizens are having to really think about or plan for estate tax. It varies on the state level, state by state, it can be a little bit different. But again, 1% of US citizens are having to consider it at the federal level. The thresholds are significantly lower on the German side, and the tax rate also is impacted by your relationship. The biggest issue that I see here is when you have two US citizens who are living and loving life in Germany, maybe they don't even have a lot of money, right? They're living their artist life in Germany, but their parents who are sitting in the US have a lot of money. And when they pass away, they're now going to leave it to their German tax resident children, right? And even if you're not a citizen, if you have residency, you may have German inheritance tax to consider. Just very high level, here are the different thresholds. If you are married, that threshold is 500,000 euros. And if you're receiving that tax allowance from a parent, it's 400,000 euros. So relatively low. These were the questions from the other events. So I'll breeze through them, but if we need to fill some time, we can go back to those. We talked a little bit about FATCA and Form 8938. Before, FATCA Form 8938 is filed with your tax return. It is going to ask for a lot of the same information as your FBAR, right? What is the different balances? Form 8938 actually is part of your US tax return that's filed, Form 1040, where your FBAR is a separate filing. Okay, and then quick shout out, we just did a FBAR self-preparation workshop. So if you're looking to learn how to prepare your own FBAR, you can go onto our passporttowealth.com/FBAR website. We have a whole live course, all the resources there for you to take the course and learn how to file your FBAR. I think it's one of the best ways, if your situation is relatively simple, that you can save on your tax preparation fees. And then we'll go through whatever questions we have, but feel free to stay connected with Emily and I. Again, I've got the Passport to Wealth podcast and then the Connected Financial Planning. And Emily owns and operates Expat Tax Solutions and has a great YouTube channel with lots of resources as well. So, Emily, are there questions that we missed that we need to run through here?
Yeah, the next question is for minor independent children, what's the filing threshold for investment earnings, which is not something I have off the top of my head, but I'm just looking it up because I have a guide chart of it. Yes. I don't know. It's complicated.
Yes, I'm thinking that too. There is a certain threshold that is tax free, and I think that was around a couple of
Yeah.
years ago. I think that was around 2,200 or $2,500 that's potentially tax free. But then you have like all these nuances built in,
Yeah.
depending on if that dependent child is working and earning income. What the IRS is trying to prevent here is having a wealthy parent shift lots of investment income over to a minor child at a lower tax bracket. So they've gotten very smart and they now apply what we call a kiddie tax. So if the investment income is too high and they don't have any earned income, so income from like a summer job or like some type of part-time job or whatever, they're children, they should be working full time, then that's going to be taxed. It's going to be taxed like at the parent's income. And if the parent is in the 37% tax bracket, then the child is going to potentially get thrown into that higher tax bracket as well.
Yeah. So these are for, I don't know if these were inflation adjusted. I haven't looked at it this year. So if the child has earned income, they have to file a tax return of their own if they have at least $13,500. And then if they don't have that, then you start looking at the kiddie tax. So then it's it's around like a 2,500. What we do see is children with PFICs. And the PFIC form is really interesting because some of the other foreign financial reporting forms, like the 8938, where you report bank accounts, specifically say if you have no tax filing requirement, you don't have to file the 8938 if you don't have any other requirement. And that's not in the PFIC form. So it's a little bit of a gray area. And I think people will take different positions on whether you have to file it regardless. And so we do find some people with children who have savings accounts. This is pretty common in Germany, to have for like a grandparent to set up the savings account and invest into the funds for the child. And then they may have taxes based on distributions in that fund, even without having a 1040 requirement.
Yep. Okay, on building wealth, holding European ETFs funds causes tax implications for U.S. citizens. What if a couple files jointly and the non-U.S. Oh, we already did that one. Sorry. Jointly in Germany, separately in the U.S. Yes. Okay. Okay. Do we have any other questions? Sorry, I saw 9, so I was like, oh my gosh, we have so many questions. We gotta finish this up. Are there any other questions? Correct. Yes. Your US Social Security is going to be reportable on the US side. So you're still going to see a number on Form 40, but it's going to be taxable only in Germany.
In order to do that, you do have to claim the treaty position. So you have to like include a form, a treaty form in the tax return that explains what you're doing to the IRS. A lot of times when you live outside of the US, you're sending your tax return they go to Austin, which is the IRS service center that deals with international things. So they're pretty good at dealing with international things. And they're like, yep, seen that all day long. That's fine. We do find some people could maintain a correspondence address in the US and they want to use that address for filing the tax return. And then you can get your notices. They'll send them to a US address, which you can get faster. Or maybe there's just like a convenience reason for using a US address. We find when some of the international returns go to they might get sent to another US service center. So where your tax return is processed depends on where your address on the return. And we find we get a lot of pushback from the non-international service centers because we're doing things that we do all the time with everyone and everyone in Austin understands it. So yeah, if you're taking a treaty position and you're living in the US and filing a tax return in the US, you might get some information. Yeah. Where you have to like answer a question and have some correspondence, some follow-up correspondence with your tax return.
That also reminds me when you're filing with, because I see this all the time, right? Using the US address, even if you have a foreign address abroad, make sure if you are looking for that automatic extension, you still need on the top of the return, it still needs to say American abroad or American outside of the US on April 15th or whatever. Like, so it's very, very clear to everyone that you're special and you get that automatic and extensions.
Mhm. Yeah, and so a non-US person would file a non-resident return to if they're getting income from the US. So if they're getting retirement income on like a 1099-R or even investment income, can file a non-resident return, and you have to claim the treaty. And so you say like, I received Social Security income, but because of the treaty, I live in another country. It's taxed in this other country. And then that gets, and then you don't have to pay taxes on it. If there was any withholding taken, then you can get a refund for that.
Yeah, great point. And if you're leaving the US system, either because you're giving up your green card, you're going expatriation, then you're going to have that dual filing status for the year that you leave. Or you were a US resident and now you've left permanently for whatever reason, you're going to have a dual status. So part of the year, you're going to file that normal 1040, and the second half of the year, whenever you officially leave and end ties with the US, you're going to file that 1040 NR, and that's like you're going to put them together. That is a great year to use a professional preparer because that is a complex filing transparently. And then also, like if you just end up having a little bit of this like income from old retirement accounts, and it's a relatively simple situation, but you're not really sure about the treaty language, that would be a year that I would hire a professional and I would basically get that format and then you have a template on how to use it. Because, I mean, maybe, I don't know how good ChatGPT is at writing treaty
Terrible.
filings. I would be cautious.
I
I
wouldn't
would say
trust
I'd be
it.
cautious.
It would make it sound good, but that's like the perfect area where the AI kind of feels where it
Treaties
like
are
sounds
complicated,
good.
and I don't like we have a lot of similarities of treaties in Europe. Germany actually has a really good treaty. Like it has a pretty good treaty. It's better than the treaty with Switzerland.
Mm-hmm.
So it's important to understand like every country has a different treaty. So again, if you're globally mobile, you're moving around, that could change how things are done. Also depends, it can depend on your citizenship. It can be, if the treaty can be written for residents, it could also be written for citizens of certain countries. So things to just kind of consider as well.
Yeah, there's also a question about the betriebliche Altersvorsorge and whether that is tricky for US taxes. So those are usually fine even when they're invested in funds. Those are okay. There's kind of like this continuum of German investment products. So, and I think many US tax, there's not clarity in the US tax law, and the IRS is not giving us a lot of specific guidance on like specific German things. So everyone's interpreting things the way that they see fit. The way we work with it is like there's kind of a continuum of German retirement products. On one side, like is like a betriebliche Altersvorsorge where you put money in and then something happens in the back end, but there's no, it's not like you have an investment account going all the way through. So like, even if it is invested in funds, they can't be traced to like your account. And then on the other side of that is like the investment or the retirement product is like, here are a series of investments. You get to choose which investment you have, and you have this account similarly to if you had like an account with Charles Schwab, where like those shares can be traced back to you, even if they're in kind of a wrapper of a retirement account. So those we're treating as investments, as PFICs. And then when it's like the more like vanilla betriebliche Altersvorsorge where something is happening on the back end, but it's like not really directly your investment account, that those are usually more fine.
Okay, great. So I think a couple of people were asking about the recording. Yes, if you're registered, I will send you the recording. And yes, we did do one of these for Democrats abroad. They are sending out the recording on their own for the other one. We're not responsible for sending that out. Karina will get that out to you. but I will send out the one, and I am hoping to do it probably tomorrow morning. I know it's Easter weekend. A lot of us are traveling and getting ready to go. So I'll try to do that tomorrow morning before we leave for a bit of a break. But if you have any other questions, you can contact us. Okay, Emily, if there's no other questions, I'm going to stop the recording now. Okay, thank you so much for joining us. Really appreciate everyone being here.
Thanks for joining.